In this video, we're going to talk about how you can use debt to make money. So before starting this video, please like this video and subscribe to our channel for future updates. Debt is a term that many people are apprehensive about hearing. The subject of debt relief is covered extensively in a wide range of television series, novels, and periodicals, among other media. Despite the fact that debt is generally regarded as a negative measure, it may also be a positive one when used properly. The most common approach of using debt to invest positively is to employ leverage to multiply your returns by an order of magnitude greater than 1. What is the definition of leverage? When you borrow money to boost your return on investment, you are said to employing leverage. In order to attain returns that were previously thought to be impossible, you may need to use leverage, which increases the danger of losing your cash. Defining good and bad debt. It's dependent on a number of criteria, whether or not a certain debt is good or bad. There's the interest rate to consider, as well as the length of time it will take you to repay the loan. Then there is the question of what you intend to use the money you have borrowed. Equally crucial is your individual debt tolerance, which should be taken into consideration. Generally speaking, good debt is borrowing that aids in the accumulation of long-term wealth. Bad debt, on the other hand, can have a negative impact on your credit and deplete your financial resources. Risk and cost are the two considerations that make a difference in this situation. Bad debt, according to David Mook, Senior Vice President and Chief Private Banking Officer at U.S. Bank Private Wealth Management, is defined as taking on too much risk without the ability to repay it. It's either too risky or too costly to be in bad debt. Credit card debt is without a doubt the most typical type of bad debt to encounter. In the United States, the average credit card amount is more over $6,000 per person. For this reason, it's considered a form of bad debt due to the exorbitant interest rates charged on the loans. The use of car loans as an example of bad debt is that they are used to borrow money in order to purchase an asset that depreciates in value. Borrowing to finance continuing living needs is not a healthy use of debt, Mook asserts in general. Good debt may help you avoid bad outcomes. Mr. Mook tells the tale of a client who was required to make a significant tax payment on April 15, much before the month of June, when he expected to receive a cash settlement. In order to pay the tax obligation, the client may have sold off certain assets in his portfolio, but doing so would have necessitated the reconstruction of his portfolio afterward, as well as the payment of transaction expenses and potentially additional taxes. As an alternative, the client chose to take out loan in order to pay the tax obligation, with the loan being repaid in June. In the Mook's words, avoiding disturbance in your portfolio is an example of using debt effectively. In order to pay down bad debts, you may want to explore using the revenue provided by a variety of different assets. After determining the amount of your bad debts, you may discover that it makes financial sense to sell an item in order to pay off your debt as quickly as possible. This is where your level of personal debt tolerance comes into the picture. Here's a list of how you can use debt to make money. Let's start. Number 5. Forex Trading. Forex trading enables investors to control big blocks of currencies with a relatively small sum of money by utilizing leverage. Currency investors have the ability to leverage their accounts 100:1. The advantages of currency trading are that you can take a modest bit of money and transform it into a large sums of money in a short period of time. George Soros is referred to as the man who broke the Bank of England because he amassed $1 billion fortune by wagering against the pound. Currency trading, on the other hand, has the potential to completely deplete a trader's account in a matter of minutes. Number 4. Short selling. Is it possible that you have sat through a financial program on television and heard someone suggest that it's time for you to short the market? It's common practice to gamble against a certain security by borrowing shares from an investor and then selling them in the hopes that the value of the shares will drop in the future. short sellers who made a fortune by correctly anticipating and capitalizing on stock price falls. The disadvantage of short selling is that losses are virtually limitless, which means that short sellers can lose significantly more money than they initially put in. Number 3. Hedge funds. In the world of financial instruments, hedge funds are among the most heavily leveraged. They're well known by creating astronomical returns through the use of leverage. Many hedge funds use leverage up to 10 times their total assets to fund their operations. Using leverage, billionaire hedge fund managers such as John Paulson have been able to make ordinary investors into multimillionaires. However, if the fund manager's investment thesis proves to be incorrect, the fund may go out of business, resulting in the loss of all investors' capital. Hedge funds like long-term capital management, which need bailout funding, were leveraged up to 30 times their assets, according to the Financial Times. Number 2. Leveraged ETFs. The use of leveraged exchange-traded funds allows investors and traders to increase their returns by taking a position long or short on a specific index. Fund firms such as ProShares offer leveraged, exchange-traded funds that allow investors to magnify their earnings and losses by 200% to 300%. These funds allow you to make investment in certain indices, bonds, commodities, or industry sectors, among other things. Number 1. Margin investing. Investing on margin enables you to purchase a larger dollar quantity of shares that you actually have the funds to purchase with. A margin account, for example, could be opened if you have $50,000 in your standard brokerage account. What do you think of our video? Let me know in the comment section down below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go. Thanks for watching.